Important formulas for any exams in the F&A domain. Let's see how many of these can you actually answer. Let's start with a couple of liquidity ratios. Can you tell me how to calculate the current ratio? I'll give you 5 seconds. The current ratio is very simple. Current assets upon current liabilities. It is a measure of short-term liquidity. Do you have enough current assets to pay off your current liabilities? The second ratio in the liquidity group is the quick ratio or the acid test ratio. Let's see if you can tell me the formula for this. Well, quick ratio is quick assets upon current liabilities. The reason why it is called the acid test ratio is that it is an even more stringent measure of liquidity. And how exactly do we calculate the numerator here? That is the quick asset calculation. It is total current assets minus your inventory minus your prepaid expenses. Now, why do we not consider inventory to be a quick asset? Whenever you purchase any item for resale or for use in the trading activity, I hope you understand that it's not necessary that it will be sold at the same price at which it has been recorded in the financial statements. There is a possibility that the stock might be sold at 40% of the amount that it was purchased for. So, having stock worth 100 rupees in the financial statements in no way means that you will end up receiving 100 rupees against that. So, it is considered the least liquid of all the assets. Also, it cannot be sold as quickly as you might imagine. What if the stock goes out of fashion? Nobody would want to purchase that. Hence, in the numerator, when we calculate quick assets, we subtract inventory and we also subtract prepaid expenses because we don't expect to receive cash against this asset. We expect to receive services against this amount in the future. So, this is how you calculate your quick assets, which is total assets, total current assets, minus stock, minus prepaid expenses, and there you have your quick assets. Let's look at a couple of profitability related ratios. The gross profit ratio, probably the easiest one of them all. Can you tell me how to calculate that? The gross profit ratio is simple. Gross profit upon net sales into 100. What is gross profit? It is sales minus cost of goods sold, and the denominator net sales is total sales minus sales return. And how do you calculate the cost of goods sold? It is opening stock plus purchases plus direct expenses minus closing stock. Another one in this same profitability group, the operating profit ratio. How do you calculate the operating profit ratio? It is operating profit upon net sales into 100. And what exactly is operating profit? The formula is total sales minus cost of goods sold minus all the operating expenses gives you your operating profit. This is primarily the profit from your main business operations, not from the financing side effects and all of that. So simply put, it is profit before interest and tax in a lot of ways, which is your operating profit. Now, to follow this up, let's see if you can tell me how to calculate the return on capital employed. The return on capital employed is a simple formula. Again, operating profit upon capital employed into 100. We discussed a minute ago how exactly is operating profit to be calculated. Let's see if you can tell me how to calculate capital employed. Capital employed is basically total of owners' funds, that is all of equity, plus long-term debt. So, that is the total amount that has been invested in the business and how much return have you generated on this particular amount. So, operating profit upon capital employed into 100 gives me my return on capital employed. It is a measure of profitability and how efficiently have I been able to use the total funds deployed in the business in order to generate returns. Now, I'm sure if you know all these ratios, you also know how to calculate the net asset turnover. How do you calculate net asset turnover? It is sales upon net assets or sales upon capital employed. This is expressed in times. What does this ratio indicate? This ratio indicates how efficiently have you used your capital employed in order to generate sales for the entity. The higher the net asset turnover, the more efficiently the business is using its assets in order to generate sales. And working capital turnover, I'm sure you know the formula to that. Let's see if you can tell that to me. The working capital turnover is again total sales upon working capital. Again, this is expressed in times. This tells me how efficiently have I used my working capital in order to generate overall sales. The higher the ratio, the more efficiently is the business operating.